My top 4 dividend stocks in the utility sector. Let's jump right in. Starting things off at number 1, we got NextEra Energy, which is the largest US stock utility company with a market cap of over $150 billion. Now, NextEra is basically split up into 3 operating segments, at least as of right now. They got their regulated side, which includes FPL and Gulf Power, and Gulf Power was acquired in the beginning of 2019, and they are going to be merging Gulf Power and FPL together by 2022. And then lastly, they got their energy resources segment, which is their non-regulated business. And now when it comes to the regulated and their non-regulated businesses and their earnings, their regulated side, which is FPL and Gulf Power, accounts for about 60% of their earnings, and the energy resources segment accounts for about 40%. Now this is a little bit important because for a regulated business like a utility company, that pretty much means that the rate that the utility can charge is regulated, therefore giving utilities a reliable and consistent income stream. Now, when it comes to capital investments and utility companies, they both go hand in hand. And for NextEra Energy, they are projected to invest about $50 to $55 billion through 2022. And this capital investment plan started in 2019. So that's about $12 to $14 billion a year, and pretty much improving on the basics like a stronger infrastructure, and as well as moving into a cleaner energy economy, and to continue their solid growth through the capital investments. Now, as far as dividends, they have been paying and increasing their dividends for 25 consecutive years. And yes, they are now part of the dividend aristocrats. So that's really good. And as far as their dividend right now, they are paying $5.60 per share, which gives them a 2% yield at current prices. However, that is lower than their 4-year dividend yield average, which is at about 2.5%. Now, as far as earnings for NextEra Energy, we do have the upcoming forecasted 4 quarters, and they are projected to do pretty well with almost double-digit growth year over year, but they are projected to do $8.90 for the next 4 quarters, and with their payout at $5.60, they have a pretty healthy payout ratio of 63%. Now, for utility companies, the payout ratio is going to be typically high, but I do think that in the low 60s is a pretty good sweet spot for a utility company. Now, as far as valuation, they do have a 5-year average PE of about 20. And I think buying the stock at a PE of under 20 would be ideal, but the stock is currently trading at around $280, and it would have to drop pretty significantly to get into a more value proposition. Now, they are trading at a forward PE right now of 31, and if you take the 2021 forecasted earnings per share, they'd be trading at a 28 forward PE. So basically, I do think the stock is pretty pricey. And as far as me holding the stock in my portfolio, I do own 3 shares at an average cost of about $247, and I do want to make this position my biggest utility position in my portfolio. I do think that NextEra has a good opportunity for nice price appreciation and for their dividend consistency. So I do want this to be my biggest utility company. And you can take a look at that with their earnings per share growth for the next 5 years at about 8% for the next 5 years, which is pretty solid for a utility company. Moving on, we got Con Ed, or Consolidated Edison, and this is one of the oldest utility stocks out there, founded in 1884, and they primarily operate from New York. Now, as far as their portfolio, they do have 56% of their portfolio coming from renewable energy and 0% from coal, and they're the second largest owner of solar electricity production in North America, number 7 in the world. And I do think that Con Ed is one of the more eco-driven companies. They really are dedicated to a cleaner energy economy, and you can see that with their capital investments, as in 2018 they spent over $1 billion on the acquisition of a subsidiary from Sempra, which helped them with their solar electricity business and pushed them up to that number 2 spot in North America. Now, as far as their dividends, they have been paying and increasing their dividends for 46 consecutive years, and they have the longest streak of any utility company in the S&P 500. 46 years is the definition of consistency. Now, as far as their dividend right now, they are paying $3.06, and at current prices, you do get a yield of about 4% on the stock, which is definitely higher than their 4-year dividend yield average. Now, as far as earnings coming up for Con Ed, their next 3 quarters aren't looking too good, but they are projected to do $4.32 for the next 4 quarters, and with their payout just over $3, that gives them a payout ratio of 71%. Now, that is definitely on the high side. Again, I like the payout ratio for utility companies to be in the low 60s, but I do keep in mind that Con Ed's track record when it comes to dividends is really good. Now, as far as valuation, they do have a 5-year average PE of about 18, and a good buying opportunity I think would be just below that 18 forward PE. And right now it's actually trading at around an 18 forward PE for the next 4 quarters at around $76 per share. So I do think the stock is pretty fairly valued. Now, as far as Consolidated Edison in my portfolio, I do own 10 shares at a cost of under $80, and I have owned these shares for quite some time right now. I have been slowly averaging down my position to get it under $80 per share, but I also don't want to get this position higher than my position in NextEra Energy. I look at Consolidated Edison as more as a dividend cash flow company with not much growth potential ahead of it. So when I'm looking at these 2 stocks in my portfolio, I kind of want NextEra to be the bigger position and then just have Con Ed as the second utility stock, which provides decent cash flow at a pretty good yield. And you can also see that with the earnings per share growth for Con Ed for the next 5 years, they are projected to grow just over 2.5%, which is fine as long as they continue to be a consistent cash flow paying company. Coming up next, we're switching it up from electricity to water with American Water Works. Now, American Water Works distributes water and manages water waste. And with water basically being essential, this is a pretty interesting business to be invested in. Now, just like any other utility company, American Water Works is definitely making capital investments. They're projected to invest about $10 billion through 2024 and $22 billion by 2029. And most of that capital investment is going towards the regulated side of their business, and that's one key point that I do like about American Water Works. They get over 80% of their revenues and net income from the regulated side, and again, the regulated side of utilities means pretty much consistent rates that they can charge to their customers and bring some stability and consistency to the earnings power for the utility company. And for American Water Works, their rate-based appreciation on the regulated side of their business is about 7 to 8% annually for the next few years, which is also really solid. Now, that's not the only thing when it comes to profitability for utilities. They also have to maintain their expenses low, and American Water Works has proven that over the years by being disciplined on their expenses. They have dropped their efficiency ratio from 46% in 2010 to 34%, and there's still some room to grow with management considering a 31% expense efficiency ratio by 2024. Now, as far as dividends, they have been paying and growing their dividends for 11 consecutive years. It's not as much as Con Ed or NextEra Energy, but it's still a pretty solid track record. And right now they are paying $2.20, and they do have an opening yield of about 1.5%, which is lower than their 4-year dividend yield average. Now, when it comes to earnings, the upcoming 4 quarters for American Water Works are projected to be really good, especially when it comes to year-over-year growth, with the next 4 quarters being positive, 2 of them being double digits. But anyways, they are projected to do $3.92 for the next 4 quarters, and with their dividend payout at $2.20, they have a really nice payout ratio of 56%, which is lower than that 60% mark. Now, as far as valuations, here's where things get a little bit tricky when it comes to American Water Works. They have a 5-year average PE of 30, and if you want to get into this stock under a 30 forward PE, you would have to get it at around $100 to $110. And the stock is currently trading at $145, so I do think that's a little bit pricey. Now, when it comes to American Water Works and my portfolio, I don't own the stock right now, and honestly, I would like to add it just to have 2 electric utilities and then 1 water utility in my portfolio, but I am in no rush to add this stock into my portfolio. If over time the valuation starts to make a little bit more sense, I do see myself owning this stock, especially since they do have good earnings growth ahead of them, which is at about 8% for the next 5 years, and if you notice, that's pretty much in line with the expected rate appreciation that American Water Works is projecting. And last on the list, we have Duke Energy, another electric utility to round off the list. And just like all the other utilities, they are projected to do massive capital investments for the next 5 years. Duke Energy is planning to do $56 billion, and they're also part of the clean energy economy as they're committed to reducing their carbon footprint of 50% by 2030 and beat net zero by 2050. Now, when it comes to dividends, they have been paying and growing their dividends for 9 consecutive years. However, they did have a little bit of a hiccup from 2007 to 2010, but it seems like that's now past them and they're on a more consistent dividend paying record right now with 9 years. And as far as their dividend right now, they are paying $3.86, and at current prices, you do have a starting yield of over 4.5%, which is slightly higher than their 4-year dividend yield average. Now, when it comes to earnings for the next 4 quarters, the next 2 quarters are projected to be pretty rough on Duke Energy, but they are projected to do $5.10 for the next 4 quarters, and with their payout at $3.86, they do have a relatively high payout ratio at 75%. Now, when it comes to valuation, I do think that Duke Energy is more of a value play, kind of like Con Ed, with an average PE of 19 over the past 5 years. And if you were to get this stock under a 19 PE, you would get it at around $86 to $92 right now. And currently the stock is actually trading at 84. So it's trading at a forward PE of about 16.5. And that's a pretty good value proposition if you would like to invest in this company. Now, as far as me owning this stock, I don't own any shares of Duke Energy, and I honestly don't plan on opening up a position in Duke Energy, even though the valuation does make a little bit of sense. But I kind of feel like NextEra is kind of like my growth play when it comes to my utility sector in my portfolio, and then I also have Con Ed as the more consistent, slow growth, but nice cash flow stock. And when it comes to Duke Energy, I feel like they're somewhere in between, and we can kind of see that with their earnings per share growth, which is higher than Con Ed at almost 4%, but it's lower than NextEra Energy. So honestly, I'd rather just own NextEra and Consolidated Edison and maybe add American Waterworks to my portfolio. But that's pretty much it. Those were my top 4 dividend stocks in the utility sector. We talked about NextEra Energy, Con Ed, American Waterworks, and Duke Energy. Hopefully the video was helpful, and thank you so much for watching.